Everyone said buy-to-let was dead. They said the golden era of property investment in the UK was over. They said the taxes, the regulations, the rising mortgage rates, all of it had killed the dream of building wealth through rental property. And honestly, a lot of people believed it. A lot of people walked away. But here is the thing nobody is talking about right now. The people who walked away, they just left the door wide open for the ones who stayed. Welcome to NestPath UK. And today, we are talking about one of the biggest investment opportunities that is sitting right in front of us in 2026. And most people are completely missing it. I want you to stick with me for the next 15 to 18 minutes. Because by the time this video ends, you are going to see the UK rental market in a way that mainstream media is not showing you. You are going to understand why the so-called death of buy-to-let is actually the rebirth of a smarter, more profitable version of it. And you are going to have a clear picture of where the real money is being made right now and how you can position yourself to benefit. Let's start with the headline number. In March 2026, there were 4.8 inquiries for every single available rental property in the UK. Let that sink in for a second. For every one home available to rent, almost 5 people are competing for it. And rental supply remains 23% below pre-pandemic levels. That is not a soft market. That is a war zone for tenants and a goldmine for landlords who are still in the game. Average UK private rents have risen to £1,374 per month as of early 2026, a 3.5% increase in just 12 months. In cities like the Northwest, rents jumped by 6.6% in a single year. The Northeast saw 5% growth. Birmingham and its commuter towns are pushing upward consistently, and the experts at Zoopla are forecasting another 2.5% rise across 2026 as a whole, with many regions performing significantly above that average. Now I know what some of you are thinking. You have heard all the doom and gloom, higher mortgage rates, Section 24 tax changes, the Renters' Rights Act, landlords leaving in their thousands. And yes, all of that is real. I am not going to pretend otherwise, because on NestPath UK we always give you the full picture, not just the headlines that sound exciting. But here is the critical thing that the doom and gloom narrative completely misses. Markets are not destroyed by challenges. They are reshaped by them. And the UK rental market right now is being reshaped in a way that is creating enormous opportunity for the right kind of investor. Let me show you exactly what I mean. Think about what has actually happened over the last 2 years. Roughly 93,000 buy-to-let landlords exited the UK market in 2025 alone. Another 110,000 are expected to follow in 2026. These are mostly small landlords, people who owned 1 or 2 properties, treated it as a side income, and found that the new rules and costs made it not worth their while anymore. When these landlords sell up, what happens to their properties? Some go to other investors. Some go to first-time buyers who move in and take those homes out of the rental market permanently. Either way, the rental stock shrinks. And what happens when you have shrinking supply and rising demand? Rents go up, void periods stay short, competition among tenants intensifies, and the landlords who remain, the ones who adapted, who structured their ownership correctly, who chose the right locations, are the ones collecting the reward. This is not theory. This is exactly what the data is showing right now. Typical rental yields across the UK are sitting at 6.93%, according to Paragon Bank. In certain northern cities, yields are approaching 8% and even 9%. In Sunderland, rental yields are close to 9%. In Burnley, yes, Burnley, average yields hit 8%. In East Ayrshire in Scotland, yields are between 7.9% and nearly 9%. These are not fringe numbers. These are real, verified figures from real markets where real investors are making real returns right now. Let me pause here for a moment because I want to challenge something. When most people think about property investment in the UK, they think about London. They think about expensive flats, high entry costs, mediocre yields, and for years, London was the default answer. But 2026 belongs to the regions. A number of smart buy-to-let investors who sold out of the southeast are actively reinvesting in northern rentals. where yields are higher, where property prices are lower, and where capital growth prospects are solid. Hull offers yields comfortably above 7%. Nottingham, with its 2 major universities, gives consistent rental demand. Stoke, Southampton, Middlesbrough, these are the places where money is being made quietly, without the fanfare of London property circles. Now, let me talk about the single most important thing that is changing the game for buy-to-let investors in 2026. And this might surprise you. It is the Renters' Rights Act. I know you have probably heard this framed as a disaster for landlords. And if you are a landlord who was relying on Section 21 no-fault evictions as a regular management tool, then yes, it changes things significantly. Section 21 has been abolished. From the 1st of May 2026, landlords must use Section 8, proving a specific legal ground to regain possession. Fixed-term tenancies are being replaced with open-ended periodic arrangements. Rent increases are limited to once per year, with 2 months formal written notice. Tenants can challenge rises at a tribunal. But here is the perspective shift I want you to have. These changes are filtering out the casual landlords, the ones who were not running their properties as proper businesses, the ones who were cutting corners, poorly managing tenancies, relying on shortcuts. They are the ones leaving. The landlords who remain, and the new investors entering the market now, are the professional ones, the ones with quality properties, good tenant relationships, proper compliance. And in a market where the amateurs have left, being a professional landlord has never been more valuable. Think about it this way. If you are a tenant looking for a rental property right now, and there are very few available, you are going to pick the best one, the cleanest, the best managed, the most fairly priced by a landlord who communicates well and maintains the property. A professional landlord offering a high-quality home is not going to struggle to find tenants. They are going to have a queue. And there is another angle here that is really important for anyone thinking about entering the market. Because so many landlords have exited or are exiting, there is stock becoming available that you can acquire at realistic prices, sometimes from motivated sellers who simply want out. These are not distressed properties necessarily. Many of them are perfectly good rental homes being sold by landlords who are done with the hassle. For an investor, coming in with the right structure and the right long-term mindset, this is a buying window. Let me talk about structure for a moment, because this is where a lot of people who want to invest in buy-to-let go wrong. The tax landscape has changed dramatically. Section 24 restrictions mean that individual higher-rate taxpayers can no longer offset their full mortgage interest against their rental income. This is what killed profitability for many existing landlords. But here is the solution that savvy investors figured out years ago, and that is now mainstream. In 2025, 43% of all buy-to-let mortgages in the UK were taken out through limited company structures, a record high. Through a limited company, mortgage interest remains fully deductible as a business expense. Corporation tax rates apply rather than personal income tax. And there are other advantages around inheritance planning and portfolio building. I am not a financial advisor, and you should absolutely get proper professional advice before making any investment decisions. That is genuinely important. But the point is this: the rules changed, and the smart money adapted. The people leaving buy-to-let are largely the ones who did not adapt. The people entering or staying are those who restructured. Let me also talk about something that is not getting nearly enough attention. The short-term let market. Platforms like Airbnb used to be an attractive alternative to traditional buy-to-let for many investors. You could list your property as a holiday let, charge much higher nightly rates, and until recently, benefit from more favorable tax treatment. That advantage has now been removed. Since April 2025, the furnished holiday let tax exemptions were abolished. Short-term let income is now taxed the same as standard rental income. On top of that, a national registration scheme for short-term lets is being introduced in England, adding compliance requirements and costs. What this means is that investors who were sitting on the fence between short-term and long-term letting are increasingly moving toward traditional buy-to-let. more capital is flowing back into the long-term rental sector, and that is another tailwind supporting the market right now. Now let me give you the regional breakdown that you actually need if you are thinking about where to invest. Because location is everything in property, and the differences between regions right now are stark. The Northwest is one of the strongest performing regions. Manchester remains a powerhouse. High demand from young professionals, strong job market, universities, and consistent rental growth. Rents in the Northwest grew 6.6% year on year. Surrounding commuter towns offer lower entry prices with solid yields. The Northeast, Sunderland, Middlesbrough, Hartlepool, these are some of the highest yield locations in the entire UK. Property prices are affordable. Rental demand from working families is steady. And as wages continue to grow nationally, affordability is gradually improving for this tenant base too. Scotland, East Ayrshire in particular, is delivering outstanding returns. Low average property prices, strong transport links to Glasgow, and tenant demand that consistently outstrips supply. Yields between 7.9% and nearly 9% make this one of the clearest value opportunities in the UK right now. The Midlands, Birmingham, Nottingham, Stoke are strong performers. Birmingham is a major city with a rapidly growing population, consistent rental demand, and a diverse economy. Nottingham's two major universities create a deep, reliable pool of student and graduate renters. Yields remain solid and void periods are low. London, the capital, still commands premium rents and has some of the fastest re-let times in the country, with void periods averaging just 20 days. But entry costs are high, yields are lower than the regions at around 5.7%, and the regulatory environment is particularly intense. London can still work, but it requires deep pockets and a long-term view. Now let me address something that I think is really important and that I want to be completely honest with you about. Because on Nestpath UK, we do not just cheerlead, we give you the full picture. Buy-to-let in 2026 is not easy. Mortgage rates remain elevated. The average 5-year fixed buy-to-let rate has been rising, sitting above 5% and in some cases higher. The cost of compliance with new energy efficiency standards is coming. The government wants all private rented homes to have a minimum C rating energy performance certificate by 2030. If you own an older property with an E or F rating, that is a significant cost you need to factor in. Making Tax Digital is also rolling out from April 2026. Landlords will need to file digital tax returns quarterly, which is a change in how you manage your finances. These are real costs, real administrative burdens, and they are exactly why it is so critical to run buy-to-let as a genuine business, with proper professional advice, proper accounting, proper management systems. The days of buying a flat and passively collecting rent while ignoring everything else are over. But for investors who take it seriously, the rewards are there. Let me give you the mindset shift that I think is most important right now. The investors who are going to do really well in the UK rental market over the next 5 to 10 years are not the ones who are waiting for everything to become easy again. Easy does not come back. The regulatory environment will continue to evolve. The tax landscape will continue to shift. Mortgage rates will go up and down. These are constants. What changes is your position relative to everyone else. Right now, with 93,000 landlords having left last year and more leaving this year, the competition on the supply side is reducing. Rental demand is not reducing, it is growing. The fundamental shortage of homes in the UK has not been solved and will not be solved quickly. Home ownership remains out of reach for millions of people, and those people need somewhere to live. The landlord who is in the market in 2026, running a well-managed, compliant, high-quality rental property in a strong location, that landlord is in a significantly better competitive position than they would have been 5 years ago when the market was crowded with casual investors. So what should you actually do with all of this? Let me leave you with something practical. If you are already a landlord, review your structure. Are you set up in the most tax-efficient way? Have you had advice on whether a limited company structure makes sense for your situation? Are your properties compliant with current and incoming regulations? The landlords who thrive in this environment are the ones who do this review now, not in 3 years when the penalties for non-compliance bite. If you are thinking about entering buy-to-let, do your research on location first. Yields vary enormously across the UK. Do not buy in London just because it feels safe. Look at the north, look at Scotland, look at the Midlands. Understand your numbers before you commit, and get proper advice on structure before you buy. If you are not ready to invest, but you want to understand this market, keep watching, keep learning. The UK property market is one of the most consistently interesting and important topics we cover here at Nespath UK. Because whether you rent, own, or invest, it affects you. The buy-to-let story is not over. It has not died. It has evolved. The version of it that is emerging in 2026 is more demanding, more professional, and more rewarding for the right investor than the old model ever was. The amateurs have left. The professionals remain. And the ones who are smart enough to enter now, structured correctly, in the right locations, with a long-term mindset, they are the ones who are going to look back on 2026 as the year they made a really smart decision. That is what we are here for at Nespath UK. Giving you the insight you need to make smarter decisions about building your life and your finances in the UK. If this video gave you something valuable today, and I genuinely hope it did, please give it a thumbs up. It is a small thing that makes a massive difference in helping this channel reach more people. If you are not subscribed yet, hit subscribe right now, because we put out content on UK housing, immigration, finance, and life every single week. And I want to hear from you. Are you a landlord navigating all these changes? Are you a first-time investor thinking about entering buy-to-let for the first time? Or are you a renter watching this just to understand what is happening in the market? Drop your situation in the comments below. I read every single one. And your question might just be the next video. Thank you for watching. Stay sharp, stay informed, and I will see you in the next one.